Global markets still see the Fed cutting in June thanks to mixed US jobs figures on Friday night. The prospect of lower US rates is dragging the US dollar down and has pushed gold to a new record high, over $2,200 US an ounce. That's coming up in our 5 Things in 5 Minutes. And then, in our bonus deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, says a fading demographic dividend for the big 4 ASEAN economies means policy changes are needed to keep annual growth around 5%.
The emphasis has to be on productivity, which has made a very small contribution over the last 3 decades, and that needs to change.
But first, in 5 and 5 with ANZ, non-farm payrolls data out of the United States on Friday night was neither too hot nor too cold for the Fed. Jobs growth of 265,000 in February was above expectations for a growth of 200,000. But there was a rise in the unemployment rate and moderate wages growth. They allowed market bets for a Fed rate cut in June to remain in place. Here's ANZ Group Chief Economist Richard Yetzinger on the timing of that cut.
That still seems too early to me. We've had July penciled for quite some time and still feeling reasonably comfortable with that. June seems very much too early from the perspective of the recent data trend. Payrolls, encouraging in a sense, it doesn't prevent the next move being a cut, but not a lot there that suggests there needs to be any urgency about that. And so I think July better than June.
Number 2. After last week's decision by the European Central Bank to hold and preview the prospect of rate cuts, Richard says there's a good chance the ECB cuts before the Fed.
That's our forecast. We have the ECB in June, the Fed in July, and the Bank of England in July. Probably the Bank of England is a bit of a toss of a coin at the moment, whether there's a bit of front-side risk to that, but certainly the ECB, the data and their signalling more recently is consistent with the beginning of the easing cycle, not too far away. The ECB's last hike also wasn't that long ago. I wonder with hindsight whether they do some assessment to think about whether that was a policy step that they needed to take.
Number 3. Richard says one currency to watch this week is the yen, which rose last week on talk the Bank of Japan may finally be able to raise its key policy rate to something that isn't negative for the first time in decades, and quite soon.
The yen's already done a few percent. It might be able to do a few more, but I think the bigger driver here is the idea that the Fed will be easing. That dollar backdrop is definitely helping, if you like, flatter what looks to be the BOJ effect on the yen. There is something of a BOJ effect, but let's remember we're talking about the Bank of Japan potentially hiking 10 basis points to take rates to zero. It's not particularly earth-shattering stuff, but it is hopefully the end of an era. I think what's more important is the dollar side of the equation, and that's stacking up for the dollar to be a bit weaker this year.
Number 4. Rates watchers in Australia will focus this week on NAB's Business Confidence Survey for February. Here's Richard again on the risks being skewed towards a rate cut by the RBA sooner rather than later.
In the last 6 months of data, Q4 last year and Q1 2024, in that 6-month period, the economy grew at an annual rate of 1%, with population growth more like 3%. So the per capita slowdown is very much there, and the soft headline performance of the economy is very much there. We've had a view the bank would start its easing cycle somewhere about November, but at this point, feeling like all the risks are to the front side of that. And the NAB survey this week, I think, the activity numbers are always interesting, but also the inflation indicators. They've been consistent with this idea that year-over-year inflation will continue to come off.
Number 5. Malaysia's central bank held its policy rate on Friday, but surprised by trying to talk up the currency. Here's ANZ economist Debali Kasaka.
A striking feature of this monetary policy statement was an explicit mention of the ringgit, which is quite rare for the BNM. It mentioned that the ringgit is currently undervalued and that it does not align with its economic fundamentals. But its recent efforts are bearing fruits, as we can see how the ringgit has performed over the past week.
Debali Kasaka there. Now, in our bonus deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, explains what is needed for the big ASEAN economies to maintain growth over 5%, as their demographic dividend fades?
Over the last 3 decades, growth in ASEAN 4, that's Indonesia, Malaysia, Philippines, and Thailand, has been fairly good. Having said that, when you look at what's really driven it, we had favorable demographics, so the contribution of labor was quite good. There was quite a bit of emphasis on investment, so that really meant that capital accumulation helped. What the missing ingredient, and this is where we can compare it with, say, a Korea or a Taiwan, was that the contribution of productivity was quite small. And that suggests that basically it wasn't easy for them to assimilate foreign technology, and probably human capital did not keep pace with the sort of technological changes we were seeing in the global economy. So the interaction between the quality of labor and capital was not as great as it could have been.
Now these countries are facing changing demographics. Can you just explain to us what they're going through?
Yes, broadly. So as is the case with sort of a demographic cycle globally, we are now going to face a slower growth in the labor force. So in that sense, it would be difficult for labor to make the same kind of contribution as it did in the past. Of course, as you pointed out, that each economy is at a different stage of the demographic cycle. And we can see that perhaps Philippines and Indonesia have the luxury, a little more luxury as far as, the demographic cycle is concerned, that labor force will not fall very rapidly or the growth will not fall very rapidly. But then when you look at Thailand, fertility rates are dropping very rapidly and they will not be able to keep up with, the same kind of labor force growth as they had in the past.
So as that labour component of growth drops off, what do these nations have to look to in order to try and drive growth?
Yes, so I think that we think that capital accumulation will also taper down in the next few years. As such, if you look at the stock of capital per person in these economies, it's substantially lower, not just compared to the US, but even if you compare it with Korea or Taiwan. Having said that, the question is why it hasn't risen. And normally what we notice is in the development of most economies, it starts to taper down over a period of time. The emphasis has to be on productivity, which has made a very small contribution over the last 3 decades. And that needs to change substantially. Now, the one way of doing it is to look at what exactly do I need to improve this. And that comes down to investing in the ICT sector, that's the information and communications technology, the physical infrastructure, and secondly, we need to improve the quality of human capital. The beauty of the ICT infrastructure is that unlike normal physical plant and equipment investment, it sort of interacts with humans in a way that it actually can enhance productivity much more than traditional plant and equipment can. So that would be a great benefit, and policymakers can move the needle on this.
So there's been a lot of focus on this concept of friendshoring or reshoring of supply chains into some of these nations. How much of a factor could that be in the growth drivers for the next decade?
It is a factor, but it is not a wholesome solution. Now, when I look at sort of friendshoring that has sort of developed over the last 2 years or so, what we see is that of these 4 economies, only in Malaysia are we seeing a substantial change. It's not happening in the other 3 economies. So I would say that it is a positive development, but it certainly cannot move the needle to the extent that government investment in the ICT sector or in terms of improving the quality of human capital, the benefits of those two are far greater than simply friendshoring.
Sanjay Mathur there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, March the 11th. Catch you tomorrow with a closer look at how China is still demanding plenty of commodities. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.